Higher for longer yields, booming AI capex, and an unusually low volatility backdrop are pulling major asset classes in different directions. This is vTalkInsight, Allocator's Lens Daily for August 25th, 2026, where we connect equities, rates, credit, FX, and commodities into one cross-asset picture. Let's start with equities, where the AI narrative and the bond market are increasingly colliding. In equities, the core tension today is between exceptional earnings from AI leaders and the drag from higher discount rates and policy risk. NVIDIA sits right at that fault line, with data center revenues still growing close to triple digits and recent signs that AI demand has risen another 20% in just a few months. The company retains more than 70% market share in accelerated computing and margins around 75%, yet its shares are in the longest losing streak since late September 1st, 2022, and repeated earnings beats have not translated into fresh rallies. The broader AI ecosystem is reinforcing both the bull case and the risk case for equities. A memory chip supercycle and a supply-demand imbalance reportedly as high as 15-1 are forcing NVIDIA to raise AI chip prices by more than 16%, while hyperscalers gear up for significantly higher capital expenditure and debt issuance to secure scarce data center capacity. That underpins strong top-line growth for tech and infrastructure, but also raises questions about how long current investment levels can run before funding costs, higher bond yields, and supply bottlenecks start to compress equity returns. Outside megacap AI, the picture is more mixed but still constructive. S&P 500 companies have delivered roughly 15% earnings per share growth this season, beating expectations, and about 3/4 of the index trade above their 200-day moving averages, pointing to solid underlying breadth even when the headline indices wobble. On weaker days, more than 300 S&P stocks have still advanced, with rotation into consumer staples, financials, and utilities as technology lags, and corporate buybacks remain robust globally, especially in Japan. Non-U.S. markets in the Pacific, including Japan and Korea, have outperformed the S&P both this year and last, with unhedged investors benefiting from currency moves. At the same time, there are clear signs of stress and concentration risk. In Asia, Alibaba's record $10 billion secondary offering in Hong Kong has been poorly received, with the stock falling around 8 to 9% on dilution fears and skepticism over aggressive AI spending against a softer e-commerce backdrop, pressuring broader regional tech. In Europe, equity markets have taken on a more defensive tilt, with personal care, consumer staples, and selected healthcare names providing diversification while technology and energy underperform on weaker oil and global tech softness. Commentary also highlights rising interest in negative beta stocks, such as large global restaurant and beverage brands, as alternative hedges against an index increasingly dominated by AI trades. Cross-asset signals add another layer. The main U.S. volatility index is still hovering in the mid-teens, which looks complacent against a backdrop of heavy Treasury issuance, geopolitical tensions from Iran to the Black Sea, and the end of earnings season as a positive catalyst. Sustained equity upside is described as increasingly reliant on FOMO-driven flows and large deals, even as higher nominal yields and the risk of an oil shock threaten long-duration sectors like technology and AI. For allocators, that points to an equity market still supported by earnings and buybacks, but with a thinner margin for policy or growth disappointments, especially around NVIDIA's results, U.S.-Canada trade frictions, and forthcoming communications from the Federal Reserve. Turning to rates, the dominant theme is that long-end yields are being driven less by inflation fears and more by fiscal arithmetic and sheer supply. Persistent, large government deficits in the U.S. and Europe, coupled with substantial new bond issuance, are straining market capacity to absorb paper and keeping upward pressure on yields, particularly at the long end of the curve. U.S. government interest payments reached a record $85 billion in August, now exceeding defense spending, underscoring how higher borrowing costs are feeding back into the fiscal debate. Yield curves are steepening globally, led by Japan, with the U.S. lagging but seen as moving toward much wider spreads between 2-year and 30-year maturities. Several views now put the odds higher that 30-year Treasury yields reach 6% before the 10-year touches 5%, reflecting concentrated pressure at the very long end. Markets increasingly believe the neutral policy rate has risen, and long-term yields are now seen as set primarily by investors rather than the Federal Reserve, with the 10-year becoming the key benchmark for economic and asset allocation decisions. Treasury and central bank actions are trying to shape this process, but with clear limits. Recent and proposed buybacks funded from the Treasury General Account, which currently holds more than $900 billion, as well as shifts toward issuing more bills, signal a desire to avoid 10-year yields breaking decisively above 5%. However, drawing down the Treasury account is not the same as quantitative easing, and history suggests that interventions only have lasting impact when backed by large-scale Federal Reserve balance sheet support, which is not on the table outside severe market disorder. That leaves term premia elevated and rate volatility at the long end closer to what allocators typically associate with emerging markets rather than the U.S. Policy communication adds another layer of uncertainty. Federal Reserve minutes show most officials still expect inflation to fall this year, but they also stress upside risks and a willingness to raise rates again if disinflation stalls, while the European Central Bank is widely expected to hike in September. Markets are watching Chair Warsh's speech at Jackson Hole closely. Clear guidance on policy criteria could spark a relief rally in rates, whereas ambiguity may embolden investors to test the Fed's resolve. Overlaying this, the strong positive correlation between oil prices and the 10-year yield means any renewed energy shock, particularly from Iran-related disruptions, could quickly push yields higher and tighten financial conditions again. In credit, surface conditions still look calm, even as underlying risks build. Investment-grade spreads are around their tightest levels in nearly 3 decades, and high-grade bond funds have seen record inflows this year, more than any full year since 2010. Yet this stability is coexisting with a massive wave of AI-related borrowing. Year-to-date, roughly $220 billion of investment-grade debt tied to AI and data center infrastructure has come to market, with some deals rivaling the size of major treasury auctions. The composition of credit risk is also changing. The high-yield market has shrunk and improved in quality over the past decade, while heavy new issuance means more risk is now concentrated in long-duration investment-grade bonds, often from issuers with negative free cash flow as they build out AI infrastructure. Investors are increasingly shifting from high-yield into shorter-dated, higher-quality corporate paper, reflecting caution about concentrated exposures and about how borrowers will manage higher coupons if growth slows. This mix of tight spreads, record issuance, and shifting risk has a late-cycle feel. Credit markets are still signaling a soft landing, as corporate spreads have not widened meaningfully despite 10-year Treasury yields in the 4 to 5% range. But several comments flag that current yields may not fully compensate taxable investors for downside scenarios. Within fixed income, sectors such as financials, aerospace and defense, and energy are highlighted as areas where recent pullbacks have improved valuations. Yet the overarching message for allocators is that the buffer in credit is thin if policy missteps, AI, capex fatigue, or an oil shock start to challenge cash flows. Across currencies, fiscal and policy concerns are increasingly expressed through FX rather than just rates. The euro has gained about 1% against the dollar this month, with options markets pointing to further upside as the so-called debasement trade remains active. A softer dollar, however, creates a headwind for European equities that earn a large share of revenues in the U.S., as translation effects become less favorable for reported earnings. North American trade tensions are adding idiosyncratic pressure. The breakdown of U.S.-Canada negotiations and planned counter-tariffs worth around $20 billion have already weighed on the Canadian dollar, with additional job losses expected from September's retaliatory measures and little sign of a political resolution before the U.S. midterm elections. That raises the risk premium on Canadian assets and complicates cross-border allocation decisions in the region. Safe haven and alternative assets complete the FX picture. Gold has risen more than 5% over the past week, and Bitcoin over 20%, moves closely tied to worries about U.S. fiscal sustainability and treasury policy, as well as to a broader de-dollarization narrative. Institutional allocations to Bitcoin have paused, with more flows going into gold exchange-traded funds, but new legislation clarifying rules for stablecoins and tokenized assets, together with renewed interest in crypto as a hedge against policy interventions in currencies and bond markets, points to a maturing digital asset infrastructure that could become more relevant in future risk-on phases. Commodities are where many of these macro and geopolitical threads come together. Oil prices have eased after 2 weeks of gains, but the balance of commentary still sees a renewed surge in crude as the primary risk to U.S. equities because of its potential to push yields higher and force a more hawkish Federal Reserve response. Iran's exports are reported to be near zero under naval blockades and sanctions. Yet Tehran still claims control over the Strait of Hormuz, while attacks in the Red Sea are forcing Saudi shipments to reroute around Africa, lengthening transit times and tightening effective supply. The U.S. is preparing unprecedented financial measures aimed at Iran, including secondary sanctions that could affect major trading partners such as China, India, and the UAE, adding further uncertainty for energy markets. Beyond oil, supply stress is visible across key industrial and agricultural commodities. Copper prices on the London Exchange have hit record highs above $14,000, driven by stockpiling and deglobalization, with inventories shifting from London to Chicago as companies hoard metal. Corn prices have climbed to a 3-year high on renewed Black Sea disruptions, and rising wheat and corn costs are feeding fresh supply-side inflationary pressure that challenges the recent disinflation narrative. Gold remains a key barometer of these risks. Prices are rising on a mix of inflation worries and fiscal concerns, with flows into gold exchange-traded funds outpacing those into crypto, and European mining stocks up 20 to 30% year-to-date on the back of gains in gold, copper, and iron ore. For multi-asset allocators, the commodity complex is reinforcing the idea that inflation and term premia may stay sticky, with energy and food shocks capable of quickly reshaping the path for rates, growth, and ultimately equity and credit valuations. Stepping back, the cross-asset picture is one of strong, but more narrowly focused equity earnings power running into a bond market that is repricing for persistent deficits, heavy issuance, and a higher neutral rate. Credit spreads and the volatility index both look unusually calm given that backdrop, even as AI-related borrowing, trade tensions, and commodity supply shocks quietly raise late-cycle risks. The dollar is losing some altitude while gold, Bitcoin, and regional currencies respond to fiscal and policy headlines, and commodities from oil to copper and grains keep the inflation and term premium debate very much alive. For allocators, the key watch points over the coming days are NVIDIA's earnings, Chair Wersh's Jackson Hole remarks, the Treasury auction calendar, and any escalation in sanctions or disruptions around Iran and the Black Sea. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.